everybody, to Mining Stock Daily. Trevor Hall here with some market commentary. Happy to welcome in a good friend of the podcast. He's also the host of the New Orleans Investment Conference and the publisher of the Gold Newsletter, which I hear is about to get sent to subscribers here soon. His name is Brien Lundin. Brien, happy to have you on. I know both of us are huge college football fans, and it's game week, my friend.
Yes, it is. Why are we talking about something so boring as metals and mining when we could be talking about Big Red?
or the Go Tigers, the LSU Tigers.
Thank you for that. That was served up to you on a silver platter. I appreciate it.
Yeah, well, who knows? Maybe the Big Red, that my Huskers will turn around, and maybe we'll find each other in some sort of postseason bowl game, Brian. One could only hope. If that's the case, the first bourbon's on me, okay?
Yeah, and I'll have all the ones after that.
Okay, very good. All right. All right. Brian, let's talk about markets, specifically precious metals markets. This is all really predicated on the crazy move that's been going on in the bond market. We've seen we've seen yields drop in the last couple days, which has actually been a pretty good boost for gold. That's also on the back of some economic data. The JOLTS data came out, and there's a lot less job openings now than were expected to hit the market. I mean, this all did well for gold. It's actually yesterday we ran up to about $1,965 front month futures basis here, and I kind of posted on Twitter yesterday that I have had that line, just a horizontal line, in 1965 on my gold chart for a long time, because it always seems like that's a huge level of resistance if we are going to make that leap towards those all-time highs. But again, sentiment still is pretty quiet out there for gold, Brian. And, I guess, how are you approaching this without spilling the beans for the newsletter and everything? How are you approaching all the data, the bond yields, and also the move in gold right now?
Yeah, a lot to talk about there. The bond yields, we were doing pretty darn well last month. In July, we went off a bottom, looked like we had bottomed in early July, and we were starting a early rebound that the summer doldrums were ending a couple of weeks early at least. And then we had a great July, but August was has not been that good to us, that kind to us. We kind of reversed everything. And that all coincided with that big sell-off in bonds that you had mentioned, the surge in yields. Despite all of that, gold has done pretty darn well. When you look at that wave in that surge in yields, gold didn't do that badly. People were talking about it's going to go down to the mid 1800s, low 1800s. It's really going to fall much further, and it didn't do that. So I think, if you're looking for a ray of sunshine in the clouds, gold's performance has actually been pretty impressive. And if you look at the macro picture right now, I think what was happening in July was that the markets were starting to price in the fundamental fact that yields had peaked, that this rate hike cycle had peaked. We might have had another quarter point, still might have another quarter point increase ahead of us. Probably not at this point, but this rate hike cycle had peaked. The Fed has finally stopped beating the market over the head with a stick. And the question then is, how long are we going to remain elevated at these levels, higher for longer and all of that? But the next big event is going to be the down cycle, decrease in rates, the rate cuts from the Fed, and what is going to cause that. So the markets were starting to price that in. Now I think after this brief sell-off in bonds that we saw over the last few weeks, I think the markets are starting to get back to that and pricing in that something is going to happen that is going to cause the Fed to lay off further and actually start to cut rates.
Last week, Jerome Powell came out there and he looked tough. He tried to look tough, and he said that 2% inflation rate target is He said it's non-negotiable. We'll see. There's a lot of things negotiable depending on the data. If you're going to be data dependent, obviously there's a number of things that are going to remain negotiable. The market is pricing. I think it's like 15% chance of a September hike, so you might as well call that zero. But pushing out later in the year, November, it's about 35-40% here. But a lot can happen. I mean, a lot can happen. I'm just kind of curious, Brian. It doesn't take much for me to see the cracks in the system based on the data.
Yeah.
Just go walk the streets. I was in Vancouver last week. I could not believe how many empty storefronts there were. Even in my hometown of Denver here, there's a lot of for lease signs, and there's not a lot of cranes as there once was in construction. I think I counted less than 10, and last year I was counting maybe a dozen or more. So, can you kind of really visually see things slowing down if you really tried?
You're starting to, and the data is starting to support that. You mentioned the JOLTS report that really jolted gold and silver, and really, had a really nice reaction in that. So bad news is good news for the metals. Bad news is good news for all of the markets because it implies that the Fed is going to lay off of rate hikes and tightening more hawkish monetary policy. And that's the bigger lesson here is that all the markets are driven by Fed policy. So if it looks like they are going to stop beating us over the head with a stick, then everything's going to respond, which is counter to what the Fed is actually doing. They are beating the economy over the head with a stick. They want a recession. They want a mild recession, but they want to kill off that seemingly unkillable jobs market in the U.S. It's starting to have an effect, as we see, and that's why the markets are starting to respond, ironically and weirdly, in a positive fashion. So, it is, if you look at all of the data, if you look at the indicators that have never failed to indicate a recession, they're all pointing toward a recession. And, everybody's trying to get it. The indicators are showing it. People are predicting, a lot of the mainstream pundits are predicting a soft landing now, but I don't know where they're getting that from. Because it would have to... You have to believe in that one thing you are taught in investing to never believe, that this time is different. And it isn't. And every indicator out there is pointing toward a recession. And again, the Fed is trying to get it. So they usually get what they want in that regard. So it's probably going to happen. More interesting to me is that I don't think the markets are factoring that in when you see buying coming into gold, for example, and we see bets being placed on the Fed actually having a rate cut at some point in its future. They're not looking at a recession. They're looking at something breaking. And I think that's still the most likely outcome. Where it's going to come, when it's going to come, I don't think anybody can predict, but you don't go from the easiest monetary policy in human history to one of the harshest tightening episodes ever seen at the flick of a figurative switch without breaking one or two things in the financial system or the economy. And I think that's some of this money that we're seeing going into gold is really a hedge on that happening at some point.
I think it was last week. I always have Bloomberg on in the morning. My kids love it. Being facetious there. But the anchor, and I don't remember who it was from Bloomberg, but she said something that kind of caught me in my tracks a little bit, and she said something along the lines of these incredibly high bond yields. And I was just, and it made me kind of pause here. And I was like, well, it's 5% on a 2-year, an incredibly high bond yield in relationship to his historical trading. But then I realized this is coming from, a younger woman. I don't know how old she was, but she definitely hadn't hadn't been there for 20 years, right? And this generational relationship that the younger demographic has with interest rates,
Yeah.
and I mean, it feels like there's a point. Is this demographic, this younger demographic, is there a good chance? And I'll say we, because I'll include myself in there. Is there a good chance that we're going to get caught off guard financially as we start participating in these markets on the pretense that money has always been easy? But if this
Yeah.
system changes, yeah.
Well, let me
Go ahead.
ask you this, Trevor. What do you think the natural rate, the average rate of interest has been throughout human history? Going back to Babylonia, Greece, Rome, throughout human history, what is the average rate of interest?
Yeah, well, I mean, I've read some Mark Chancellor about it, and so I feel
Yeah.
somewhat educated. And I think it's like double digits.
But actually, it's right about 6%.
Oh, really?
Yeah,
Okay.
6% is the average rate of interest. So, you know, and my point being that 0% interest is not normal, to
Right.
say the least. And you'll see throughout everything we've been through, you see the talking heads on Bloomberg and CNBC talk about the markets like this crap is normal, and it is not. If you would have predicted any of what we've seen over the last, uh, 14 years, 15 years, if you would have predicted any of that pre 2008, they would have put the tinfoil hat on you and jerked you off the stage. And it was crazy talk. And now it's accepted as normal when you have interest rates zero, negative yielding sovereign bonds. What we're going through today with this kind of tightening with debt this large, $1 trillion a year paid in interest on the national debt, not $1 trillion in the federal budget or anything.
Right.
Interest on the federal debt, paying about $1 trillion just on that. None of this stuff is normal. And you're right. These people right now that are operating in the markets feel like it's normal, and they are just going to get absolutely blindsided by what's ahead.
Yeah. Let's talk about the gold equities, the precious metals equities here. They're kind of all over the place. Brien, I have noticed, and I think you can make an argument if technical analysis is beneficial for junior equities, especially in times of very low volume and low sentiment. Let's table that. But looking at some of these charts, it does. I was kind of poking around this week, and it's like I kind of felt like some of these good names in the junior equities that continue to be beat up have found some sort of bottoming. They haven't been. A lot of them haven't caught up with this move in gold of the last couple of days, but there maybe is an argument that they have started to bottom. What are you seeing out of the junior equities? Is anything improving? Because it doesn't seem like it's getting any worse.
Yeah, it's been kind of steady state. You can't go any lower because if you go lower, you have to have people selling, but you also have people buying at those lower levels. So there's been some selling exhaustion, but it's hard to say it's really selling exhaustion because it's just nobody really buying right now. Not a lot of money or a lot of liquidity being able to be put into the market right now. That will change so quickly, it'll give you whiplash. I tell people all the time that in this market, it's so speculative, and there's a real sense of FOMO that hits where people don't want to miss out when it does turn. But what we need now is a consistent uptrend of the metals. The metals don't care or gauge or track the sentiment in Vancouver or Toronto. It really is irrelevant. What moves the metals are larger macroeconomic fundamentals and dynamics, and when they start to move, then you'll see the seniors start to move, and it'll filter down very quickly with only really 2 or 3 weeks of a consistent uptrend in gold and silver. you'll see that junior market absolutely catch on fire. And that's what we need. You look back around 2000, 1999, 2000, we bottomed out then. The mining stock market was totally in the dump. And it had good reason to be, because metals prices were, gold had bottomed at $252 an ounce. So back then we had a similar metals market, but the mining share market, but the metals were in the dumps. Right now we have really good prices in gold and silver, decent prices, at least for the producers. But nobody's excited because the market doesn't care where prices are, it cares where they're going. So if we get a bit of an uptrend from these levels, and we don't need to go much higher. You talked about gold. We're within about 7% or so of an all-time high. If we get to 2060 or 2065, we're going to break into uncharted territory, and then you're going to have huge money coming in. So we're in I think an extraordinary position right now. I think it's a generational opportunity when you have so many companies with real value in the junior sector, identified resources, that are selling for just, not just, at 52-week lows, but at fractions of where they should be with metals prices this high. So the rebound could be very abrupt, very sudden, and, hopefully we're going to get that as we get into the fall.
Yeah. Speaking of the fall, we got a couple conferences lined up here in the next couple of weeks here, Brien. Just curious, any specific companies you're really looking forward to touching base with, or maybe learning more of during a lot of these one-to-one meetings?
Specific companies, I think, I'm learning about a lot of opportunities. It really is frustrating to me personally, because I deployed all of my available risk capital earlier in the year, and there's so many companies out there that I think are just exceptional, really generational opportunities that I'd like to buy or buy more of, but really can't, because you have to sell. I have to sell something to buy something, and it's not a good market to sell something right now. There's a lot of great stories out there. I like Vizsla Silver. I do own that one. It's I think it's a great story, and getting just criminally undervalued right now. Outside of the gold sector, and this is nothing new. I like Fireweed Metals. I also own that. I think that's going much higher over the long term. Very well run. It's becoming a strategic asset. So that's two off the top of my head that I really like right now.
All right, my friend. Best of luck here on opening game day here for both of our respected teams. Hope you do well, but not as good as us. And I look forward to seeing you on the road. I appreciate your time here, Brien. I know you're busy with that newsletter, so I'll let you get back to it.
I'm getting ready for my conference too. I hope you can make it down to New Orleans this year.
Yeah, give us the dates again. Give us the info before we let you go.
November 1st through the 4th this year. And the speaker roster is mind-blowingly good. Take a look at it.
All right. And what's the website?
NewOrleansConference.com. Real simple. NewOrleansConference.com.
All right, Brien. Take care, my friend. Thanks so much.
Thank you.